Thank you very much for coming this morning for this presentation, Angel Investing for Founders 101. I hope that you find the session really informative. Before we get started, I'd like to just take a moment to recognize that where this presentation is happening, which is in Kingston, Ontario, we are situated on the traditional lands of the Anishinaabe and Haudenosaunee peoples. We're very grateful to be able to live and learn and be present on these lands today. If you're not from the Kingston area, I encourage you to look up on whose traditional lands that you are situated on and just take a moment to acknowledge those who were and who continue to be stewards of the land in your area. Quick housekeeping also before we start. If you have questions, you can put them in the chat, but we're going to be reserving questions kind of until the end of the presentation. So we'll keep track of the questions that you're asking, but just if you don't want to forget it, feel free to pop that in the chat and we'll be sure to get to it at the end of the presentation. So I'm going to now hand it over to Michael Coates for SOAN, and yeah. Go ahead, Michael.
Thank you very much, Amanda. And thank you, Carrie, both of you for inviting the Southeastern Ontario Angel Network to do a presentation. There's a lot of information that I'll be covering here. So as Amanda indicated, feel free to drop some of those questions in the chat, and be sure to address those in the end. So let me just get quickly organized here. While I get my presentation set up, everybody just drop in the chat where you're calling from, what city you're calling in from. All right, where are we calling from? Kingston, Belleville, Perth, Westport, Vancouver, from the UK. Very good. Baltimore, Mississauga, Toronto. Excellent. Well, welcome everybody. In regards to this presentation is for the most part pretty broad, but SOAN, we do cover a very specific territory, but the language, the terminology, everything that's going to be really discussed in this presentation is you can be used all across the world for the most part. So, Angel Investing 101, what you really need to know as a founder. Today, in short, we're going to be talking about angel investors and the various networks, the various stages of growth in the investment rounds, the various types of funding. And of course, the most important, the pitch, the pitch deck, and what makes up a good pitch that investors would want to see. So, who am I? Who's this talking head that's going to be speaking to you for the next hour? Trying to make this as exciting and interactive as possible. I'm the current director of portfolio management and operations for SOAN. I've been with SOAN for almost about 3 years now. I've seen a lot of deals, a lot of exciting companies coming through, engaged with a lot of investors to invest in various startups across Eastern Ontario. My background, currently I'm a co-founder of Major Impact, a growth marketing agency working with social and environmentally conscious businesses. I've raised angel funding for my previous businesses. I've had multiple businesses before. I've also received some government funding as well through various government funding programs that are out there, which I'll be talking about. I've advised and currently advising various startups across North America. I've had many failures. I've had successes. But really, at the end of the day, it really comes down to, as an entrepreneur, as a founder, grit, persistence, and what I like to call 10xing. Meaning if that you have a goal to do 10 cold sales like emails or phone calls in a week, do 100. Everything that you do, go above and beyond. can be a daunting task to be a founder, but set those lofty goals to strive for. The overall mission of SOAN, since 2014, the Southeastern Ontario Angel Network has been created to facilitate the mobilization of investments from accredited investors into companies being developed in Southeastern Ontario. But SOAN is part of a larger group of angel networks. Through Angel Investors Ontario, there's 13 investment groups all across the province, and there's about more than 1,500 now. There's probably about 1,800 active members, being private angel investors that make up most of these investor groups. There are really smaller investor groups that aren't part of the AIO. There's also private family offices as well. But for the most part, this network, we syndicate deals, meaning we share deals. So if there's something of interest that may not fit our current investor portfolio or profile, then this is something that we can share and provide access to other networks across the province. The AIO is also part of a provincial-wide network of innovation. So that includes Queen's University in this area, along with Launch Lab, which is a very active partner with SOAN. I previously worked with Launch Lab, and Launch Lab is an organization that helps entrepreneurs helping entrepreneurs. Part of that provincial-wide network, of course, is local economic development agencies, such as a Kingston Economic Development Agency here in Kingston. So there's a lot of resources, a lot of networks that you can tap into, regardless of where you are, at least in Ontario. And for the most part, I've lived in the UK, I've lived in BC, and each country, each province, territory, state has very similar innovation networks that you can tap into. It's just a matter of getting yourself in there and making those introductions, getting those connections, and don't be afraid to say hello and ask for help. For the most part, investors invest in a whole whackload of various companies and categories, industries. They could be Internet of Things, IoT, agricultural technology, advanced manufacturing, healthcare, which is Kingston's kind of flag in the ground, healthcare innovation, cybersecurity, marketplaces, just about anything. When I say anything, it really has to coincide with the philosophy of investors or investment criteria. So opportunities that do have high growth potential. I'll cover that more in greater detail in this presentation. But if you've got, a really great idea, you've got customers, and there's an opportunity for high growth, high scalability, you would be a candidate for an investment. Investors really do give more than just money. They bring expertise. For the most part, they are successful in their own right, whether they have scaled a business and sold it for multiples, so millions of dollars, or they're currently a business individual that has a very successful growing business, but looking to inject capital into businesses. They bring, of course, acumen, vertical expertise. So if they had a startup in healthcare innovation, they've sold their business to a Canadian or a US-based like private equity firm or a strategic partner, they can bring not only their knowledge and expertise, but they can also bring their Rolodex in many instances as well. Of course, I mean, the financial aspect of it is a big one. And another important piece of it is overall business development, their perspective, their experience. They are really can be the more active angels that make investments. They help mentor, they help coach, not paid, because I mean they have an interest to seeing their investment succeed, so they invest in you. So they want to see you succeed, so they work with you to help grow and scale, because it's a way to solidify their investment in many ways. So they're really invested in you, not only your business, but you yourself. Who are they? I mean, for the most part, as I alluded to, they've either sold a business for many millions of dollars, and they're looking to diversify their investment portfolio. So they're looking at businesses because they were once a first-time founder and they went through the exact same process that you're going through right now. So they're in many ways pay it forward, right? They're very kind and very humble. They want to see you succeed because they've been there. And 90% of the time, whenever I speak to a multiple founder or one that just recently exited, they're like, I want to help aspiring entrepreneurs because I've been there and I've had one or two key individuals that had helped me grow and scale or get that connection to help raise the money needed to hire the next round of people or to get those customers. So they really do care about about who you are. They've been there, and in many instances, cash isn't the only driver, right? They, at least through SOAN, we do have quite a few active investors. Some that really like to work and engage and teach, mentor, the investor, or sorry, the founder. And some maybe a little bit more passive. They just want to put $25,000 or $100,000 into a business and just see it and watch it grow. But from our experience, at least in this angel network, we do have a lot of investors that are very, very active. So angel investment really fills a gap, and it's a point of, in many ways, commercialization. So you've got the earlier stage. So you're at the you're really at the prototype. You're testing. There's probably some of you on here that have developed some intellectual property or an invention. You have something and you're looking to commercialize it. You put a bit of your money and resources into it. You ask some family and friends to put some money into it. You test it. You get a working prototype. And then from there, you're like, okay, I've got the prototype. I have some customers, or I've gotten some feedback. It's still too early for venture capital. That's where angel investors come in. They fill that gap where they, in many ways, bridge the gap between the earlier stages and then the point of venture capital, which typically is anywhere raising money anywhere from $1 million, $3 million, $5 million plus. So they play a very important role in the commercialization and the growth of companies. So typically they're looking for an opportunity that is a superior product or service compared to the status quo to other competitors. Whether it's the user interface, so it's much easier to use, whether it's a cost, whether it's a value proposition, whichever angle, whichever the unique value proposition is, you have a superior product or service. It's a business model that is clear to understand. In many ways, if you can teach like a grade 8 or a grade 9, it's just like, hey, like these are the customers, here's the business model. In a way, putting it in layman's term that is really easy to understand, because when the business model is overly complicated, not only is it hard for you to pitch, you to sell to the investors, but also your team, as you start to onboard team and trying to work the business model. So having a simplified business model that every stakeholder, so stakeholder being customer, being your team, investors, it's so important to have a business model that everyone can understand. Obviously, very high growth potential in your business idea. Global opportunity, so not just a business that would service Kingston, but Canada, North America, Western Hemisphere, and the entire world. Very rarely will an investor, unless if it out of like good heart, will fund a brick and mortar business, like a restaurant, because the high growth potential of a restaurant is quite small, unless if they developed the world's best sweet chili Thai sauce or best product that can go to the global market. A very, very clear and sustainable competitive advantage. This is an important one. A quality management team. Investors, more often than not, will invest in a B product, but an A team versus an A product and a B team. Okay, so investors will look at the team over the product or service above anything else, because if the team cannot execute, then there's really no valid business opportunity, right? If they're lack of professionalism, or they don't understand the other market or their products, they don't have a clear roadmap, it's hard to sell anything. You need to have a really good team to be able to execute. Existing customers and partners, right? So do you have customers that are talking about your product or service? Have they given you feedback? Do you have letters of intent, LOIs, or MOUs, memorandum of understanding, where it is a non-binding agreement saying like, so your customers would say, yes, I love your product, I want to buy. That helps not only in raising money, but also to leverage debt financing through banks as well. So you have a realistic and an alternative exit and liquidity strategy. Another important one, because investors, they're in this to make money, of course. So for them to have an understanding of where they or how they're going to make money is important. So understanding the liquidity event where it's like you get acquired, there's IPO, or alternatively, there could be like an investor buyback where after a certain period of time, you're like, hey, investor, thank you so much. Would love to buy back your shares, but with interest, with like a 10%, 12% interest, or some other structure that you can talk about. So you can always buy back, the shares. Very rarely that that they will do that, because they want to see, their $100,000 turned into $1 million versus 100,000 turning into 200,000. And the professional business practices of the individual. Are you professional, right? Are you coming to meetings with a hat, and a hoodie, or are you coming in, well-groomed, sharp as a tack, well rested? Founders, please ensure that you are resting and recovering, because it is so important. It is so important to be on top of your game at all times. And rest. I've done the 15, 16 hour days, did that in my early 20s, and it was extremely exhausting, to the point where I did a presentation to Tim Hortons and I was extremely exhausted from all the work, the nights before, and I would stumble my presentation. I was not actively listening to their questions. It still was a successful meeting, but afterwards I'm like, darn, did I screw this up, right? So the rounds. As a founder, understanding the roadmap of getting money today, getting money tomorrow, getting money 5 years, 10 years from now, to fuel growth, to fuel the expansion and the operations of your business, or of your product or service. So there's a great deal of information, and I'm just gonna really speak to about angels and the gap that they fill. So really, a typical angel round is you have an initial working prototype that is being tested. Target investors are the 3 Fs: family, friends, family, fools. Of course, angel investors, accelerators are also a really great option for early stage funding, not only for funding, but going through a 6, 10, 12-week intensive can really help with connections, refining your pitch, your business model, your projections. There's a lot of value that can come from working with accelerators. And there are very few select VCs, early stage, pre-seed, seed VCs. They're very strict criteria, and for the most part, you need to hit a lot of these financial metrics that you see in the middle there, which the stage pre-seed to seed, anywhere from really like even 100,000. Like if you need to battle test some of your initial prototyping, if you have a select group of beta customers, so you've got 20 individuals that you have identified that could, and it's not your friends and family, they have to be unbiased, they need to be in a position to give honest and open feedback about your product. your prototype. And typical valuation, I mean, that's always a tricky one. Time and again, the founder's like, I have no idea what my valuation is. Well, do some quick Google searches. You'll find it on Forbes, on various, like on Investopedia. You'll find them on various websites of typical valuation for your particular, like, your product or service, right? So if you're healthcare innovation, you see some comps, so comparables of a similar business, and there could be pre-seed to seed, and there a valuation for Acme Corp and healthcare innovation, that their valuation is 4 million. It's really an arbitrary number at the pre-seed seed round because you don't have the units of economics proven. Like, okay, number of customers, what they're really willing to pay, what the lifetime value is, what your EBITDA is, right? Net revenue, and all those other important units of economics to calculate what your valuation is. Your annual reoccurring revenue is really less than $1 million, if any at all. For the most part, early stage, you don't have your funding, you don't have revenue, right? Pre-seed, seed, you're still in that pre-revenue stage, which of course can be difficult to pitch because investors do want to see a little bit of traction, right? So customers for business to business, B2B, 3 to 10 is a really good number, or for business to consumer, about 50 to 1,000. It's easier to say, like, hey, investor, I have 100, business to consumer, because that's the niche, that's the vertical that I'm in, or the customer segment that I'm targeting, or consumers. I have 100 prototyped the product or service. This is their feedback. They love it, and now we're going to market. But we need $250,000 to build the platform, to build the widget, hire some key employees, to take it to the next stage. And the strategic metrics are strong value proposition, as mentioned, an early indication of customer interest, and that the product is really, or the business is really scalable. If you can show that there's scalability and the forecasted unit of economics that say, like, yes, this is a good idea, this is going to work because of these reasons, or because customers are saying this, like, getting the feedback early stage, prototype, beta phase is really, really, really important, because it can help define what your end product is going to look like. And this I pulled from this morning. From my marketing company, my UX UI designer shared this with me, and in many ways, let me know if you can see that. Carrie, can you see that? I just see you. Yeah, perfect. So we have, as founders, we have the incredible ability to be visionaries and to have this idea of what our product is, your business is going to be, right? So during the planning phase, it's like, yes, okay, this is what the horse is going to look like. This is what it's going to look like. But as you go through the design, develop, test, and release, process, once you start getting feedback from your customers, because you can't assume that what your customers want. You have to go out and talk to your customers, listen to them. Don't tell them it's like, well, you're doing it all wrong. It's like, no, listen to them, because at the end of the day, customers are usually always right, especially in early stage. In many instances, as an early stage founder, you will go through multiple iterations. You will pivot your business model. You'll pivot your feature, your widget, multiple times over. That has happened through, Facebook, right? Every single unicorn you could think of, they've gone through at least 2 to 3 different pivots or iterations of their product. And as you see through updates of these various platforms, is that they listen to the general consensus of the group, whether it's through Net Promoter Score, whether it's listening to what people are saying on Reddit, social media, and adopting that to your business. So just remember, it's like, you have a gift to be visionaries, but just know that it will likely change, and it is okay to change. It is okay at the end of the day, because you're providing value to your customers, and you want to make them happy. You want to have them feel heard and listened to. So go out there and just get it out there. Don't be shy. Like, still a beautiful horse. Okay. It's a winning horse. It's a winning horse. Okay. So the startup life cycle, there's really 5 key stages. Could be more, but for the most part, for a startup founder, as mentioned, you've got this beta stage, the MVP, minimal viable product. So back to that picture of the horse, is you're listening to the feedback, you're developing your prototype, you're getting it out, you get some customers on, you're listening to them, adopting the feedback, and now you're really starting to put together your pitch and start getting some early stage angel investors to invest in your idea, which can range from anywhere from $250 to $3 million in money that you will likely need for a small team to take it from a bench scale prototype to the next stage. And the next stage is product market fit, PMF, right? And that is typically in a Series A stage where your valuation is much more because you have paying customers in $100,000+ in recurring revenue, and you're looking to raise anywhere from 4 to 10. Not really any much more than that, because there's a challenge if you raise too much, you're going to dilute yourself, which we'll talk about. And when you raise too much, when you have too much money in your piggy bank, habit has shown that founders typically spend more than they absolutely need to. So if you can continue to bootstrap through your seed and Series A, you'll make smarter decisions, right? Because you won't be able to overspend. You have to think of it as like as a growth, like a growth marketer. It's like, okay, how can you unlock growth in the most cost-effective way possible? And in the Series A to Series B, that's when you take a lot of the money and fuel your funding growth, right? Through customer acquisition, product development, and a lot of paid marketing to grow and scale your business. And then from there, you're at an exit in which you sell the company through various vehicles, and you get your paycheck, and so do all your investors. Your investors are happy. You put all your blood, sweat, and tears into it, and you can rest for a few months. You get the itch. You want to start something new. Then you have a Rolodex of investors that have made money through you. You have your next idea. And once, as first-time founders, when you are successful once, raising money and starting a business idea again is significantly easier because you understand the terms. You have the Rolodex. You identify problems and solutions, you identify problems, maybe during the entire life cycle of your business, and you're like, oh, there's an idea, but we can't do anything because I need to stick to the vision of the company that I'm working on now. Afterwards, you can pick away at those ideas, and that's why you see you see founders that have exited once, founding a company a second time, a third time, and sometimes even a fourth time, and continue to grow, or they get into venture capital and create and invest in a portfolio of companies. And it can take up to 7 to 10 years for you to reach an exit. So keep that in mind. In some instances, I'll give you an example where that might not actually be the case, but dilutive and non-dilutive funding. So dilution, occurs when a company issues new stock, in return for capital, and this results in a decrease of ownership, right? And there's really two downsides, which is reduced control and really a lower upside. And both of these have important implications to you as a founder. The first one is the reduced control. So you can experience significant dilution over successive funding rounds. So in this example, like today, first time as a founder, you own 100% of it. But as you go through each successful round, you start to lose ownership of your business, and with that comes you lose board representation, which can impact strategic decisions and overall approval rights. Like if you lose a majority ownership, then you start to lose your overall control and direction of your company. So this is really, really important, and that knowing this down the road will impact what you're raising today, right? So maybe you don't want to raise $1 million and give up 40% of your company today, because if you need a Series A, you'll be less than 50%. It will just be heavily diluted over a period of time, and you will lose control. Depending on where you want to be in 5-7 years, or where the vision of the company, maybe it makes more sense to raise 300,000 and being more creative to find some strategic partners or customers, where instead of speaking to one customer after the next, maybe there's an association or organization that has 200 of your targeted customers. That makes more sense to go through that channel versus going B2C one by one. All depends on your business model. Second example is the lower upside. So 3 different options. We've got a $20 million exit, $100 million, and a $200 million exit. The key difference really between these 3 exits is the internal rate of return. So write that one down. It's important to know and understand. But really, if you own 100% of 20 million, but you're able to sell it within 3 years, your internal rate of return is 242%. On the other side, if you have a $200 million company and it takes 8 years, and you have 10%, it's still 20 million, but you're 3 years between 8 years, and plus when it's a $200 million company, you have hundreds, if not thousands, of employees. You've got boards of directors. You're losing control. At 10%, like you have very little control or say about the day-to-day operations, right? So many instances, if you can maintain or retain ownership within your business, that more often than not is ideal. Alternatives. So you've got grants. So work with your local economic development agency. Work in this case with Queen's University. We can OPI work with Launch Lab to understand what some non-dilutive financing would be. So you don't have to give up ownership, right? So there are some tax credits, some wage subsidies, super clusters. The thing about grants is you cannot build a business model. So when you're working on your projections, have that as a separate line item, because you can't build a sustainable business based off of grants. Okay, so you have to build your model around revenue and actual customers, and not grants. Okay, so that's going to be a separate line item. It's really just going to be a perk to everything else that you're doing. And of course, the debt. You've got term loan, line of credit. There's some inherent challenges with debt because there's interest and all the other potential costs associated to debt financing and the collateral. Like, are you going to have to put up your house? Do you want to do that? Versus going the dilutive way and getting some outside funding. So just looking at the time here, I'm just going to kind of quickly go through this. So dilutive. So the types, the vehicles are common and preferred shares, convertible debt or convertible note. Other common instruments are safes, simple agreement for future equity. Warrants is another type of investment vehicle on the dilutive side. The benefits, no future business cost, and really can fuel growth. Really, at the end of the day, can fuel fast, quick growth. The overall cost is, as you saw in the dilution, is you will give up a lifetime stake. You lose control. It's the most expensive cost of capital. And the legal costs can be quite high. That's why founders and investors are really liking the simple agreement for future equity, SAFE agreements, because it's not a 20-page document. It's typically only 5. And the terms and conditions are much smaller than like a convertible debt or a convertible loan type vehicle. Non-dilutive, you get to maintain control and ownership. It really is a cheap cost of capital in comparison to to the giving up your control and lifetime stake of the company. Inexpensive legal costs, but the potential future drawdown of the business can be challenging in the covenants of the business operations as well. But if you're looking at non-dilutive, I mean, speak to your bank, weigh out your options. It's really best to have as many conversations as possible, and creating a chart or however you kind of formalize your ideas or your thought process, and just weigh out the pros and cons of each. Some of the common instruments that I had mentioned: convertible debenture, pref shares, which is just straight equity, warrants, or simple agreement for future equity, which typically activates on a future fundraising round in which your investors then will get equity in your company. The cap table. This is an important one, really, really important one, because this will also determine, again, like, are you going to raise $1 million or are you going to raise 500? If you're raising 500, your business model, your revenue model will have to, of course, adjust accordingly. But then you'll lose, you'll have more ownership versus raising $1 million. And the cap table doesn't need to look like this. Okay. It really, really doesn't need to look like this. You can use a Google Excel or Google Sheet or Excel to create your cap table. It's really, really important to have this and to have this in your back pocket when you are raising money, because this will always be a question. Okay, who is on your cap table? Who, meaning founders, ESOP, employee stock option pool. First investor could be family, second friends, third fools, and then getting into angel investors. And having too many people on your cap table can be detrimental for future raises. I mean, that's a whole other can of worms that would be for another conversation, but you really want to be conscious to simplify your cap table and to consider what your future roadmap is going to look like after each successive round of funding, right? So today you and 3 other founders are at 33.3%. You go and raise a ownership in your company. So consider this. Try to, you don't have to create a complicated Excel cap table, but map this out for yourself. And I mean, if you're looking to raise seed today, you may not know what you're going to need to raise for a Series A, especially for a Series B or Series C, but at least for the next 2 rounds, getting an idea of where you sit and how much money that, where's that threshold of how much, you need to raise and how much is kind of that minimum threshold to raise to ensure that you reach, your next milestone. The pitch. So it's important to, the origin story, like the why. You want to pull heartstrings right from the beginning, right from the get-go. You want to be able to pull the heartstrings and introduce who and what you are. Defining the problem, your market size. So not necessarily your total addressable market, right? Because healthcare innovation can be a $1 trillion industry, but you're only targeting maybe wearables, which would be maybe $50 billion. So you want to look at your serviceable addressable market, right? Your SAM. So not a top-down approach, but a bottom-up approach to identify what your market size is, and that will help investors visualize their potential returns. Like, oh my gosh, like if we can get 10% of a $50 billion serviceable market, I mean, great. That's that's a $5 billion company if you just get 10%. It makes it more realistic, more tangible for investors. Your why now, like, the solution. Why has this been done before? Why hasn't it been done before? What makes you different than all the other noise out there? Your go-to-market strategy. So how are you going to get customers? Your key differentiation to your competitors or your competitive moat. Of course, your revenue. In many ways, it's hard to calculate. We'll get to that in a moment. Revenue projections, really one of the same. Of course, highlighting your team. So that's your advisors, your team, and maybe some like key hires, or like if you have some contractors on that you'd like to bring on full time, just identify who they are and list, don't go into great detail, but maybe just list or having logos of the organizations or companies that they have experience with or currently working at. The ask, the use of funds, and of course, summary. The important part about pitching is simplify it. Use bullet points. Do not put a lot of sentences on. I mean, to me, this deck that I'm showing you right now is too text intensive. But for yourself, you really want to use the power of visuals, bullets, and pitching for investment. Your pitch deck is something we could talk about for 2 hours. There's a lot of great detail for each slide, but trying to keep it between 10 to 12 slides at most. Keep it super simple, super easy to read, because investors will go through hundreds of presentations in a year. So make sure that you stick out from the rest of the crowd. Yeah, I'm going to, yeah, so your business, really, what is your product market fit? Like, do you have product market fit, right? How big is the market opportunity? And really, one thing I want to touch on is the founders, right? Is there a founder market fit, right? Does the team really work together? Do they jive? Do they have, so we got the CEO, got the CTO, and the COO. If there's 3 founders, are they working in their lanes, right? Or is there any crossover? The founder market fit, as mentioned about the quality management team, is really, really important, and that investors want to see an A team, over a B team that they will invest in. You really also want to highlight how you will differentiate yourself from all the other noise out there, right? What is your product differentiation and your marketing differentiation as well, right? Like, what is different about your product compared to competitors, and how are you going to get it to your customers, compared to your competitors? Growth projections, your revenue, your financials. It's really hard as an early stage founder to determine what that is. Use your best guess. Of course, it's always a hockey stick curve up. It's just naturally, it's like, okay, 1 customer, next month, 2, 10 customers, 20 customers, 100, 1,000 customers. It's really, it's always this hockey stick curve, but really the reality is that is the process. Like, you'll get some interest, you'll lose interest, the ebbs and flows. This is a natural occurrence. It's not a hockey stick curve. You'll lose money. You'll need to invest in more in customer acquisition. But do your best, and investors will know that too. Like, unless if you're a Series A, like you're going for a Series A and you're 2 years in business and you're doing thousands of dollars a month, you have historical data to use for your projections, right? So it's really just a best guess. The units of economics, the metrics for scalability and profitability, these are important metrics, really depending on your business. But what's your CAC? What's your customer acquisition cost? Okay, like, how much are you paying for a customer, and what is their lifetime value? So, if the lifetime value is 1,000 and the customer acquisition cost is $10, that is extremely profitable and scalable. What's your annual recurring revenue and your monthly recurring revenue? Pick one or the other. Don't do both. Earlier stage, probably go with MRR, and understanding what your month over month, growth numbers are or aspiring to be when you start to calculate your projections. Your number of customers, and then your customer growth and churn rate. So how many customers are you losing a month? If you're losing 20%, that's not good, because over the period of the year, you're going to be at a downfall. So keeping it at like a traditional 5-7% is a good place to be. Keeping it under 5% is absolutely ideal. Understanding your cash dynamics. Obviously, this is important, understanding your financials. So work with your mentor, your business advisor, reach out to OPI, Queens, we reach out to Launch Lab. We can really help you understand the cash dynamics. I'm just going to quickly skip over this because I do want to give some time for Q&A. But yeah, so this is really, really important, because you're selling yourself, you're selling your idea, and you're pitching. So really just want to leave this as the last slide, because if you can't sell yourself, or if you think that you are not prepared to pitch, and if you have a co-founder, maybe ask your co-founder to do it, right? Or just work. I used to practice in front of a mirror time and time and again, talking to myself, recording myself. It's really awkward watching your recording of yourself, but do it. Polish up, refine your pitch, and try to practice your pitch to friends and family, but your mentor, your business advisor, maybe even to some customers as well. Because if your customers don't understand your business model, what your proposition is, investors won't either. So I'd like to end it there, and I know that was a lot. That's a lot of information. But let's open it up to questions.
Okay, we had quite a few questions in the chat. So I'll go back to the beginning. I've copied and pasted them over here. So
Okay.
we'll start at the top here. One of the questions was if you had any book recommendations for early stage startup financials, particularly for building pitch decks. There were some suggestions in the comments as well. David Rose, The Startup Checklist, and Carl Schramm's Burn the Business Plan. But if you have any recommendations to add to that, Michael, that would be great.
Pretty technical perspective would be Brad Feld. He pretty much started the Boulder, Colorado Techstars, and I mean this was like early 2000s. He was kind of one of the pioneering angel investors in that area, and he one book that I found to be more useful as an audiobook rather than actually reading, just because there's a lot of technical information in the earlier years, was Venture Deals, right, by Brad Feld. So that's a good one, but the other ones that were listed are also really good resources.
So the next question was, regardless of what the valuation of a startup might be, what does the average angel investor expect as far as equity? 20%? If that assumption is correct, the startup should also understand what it needs to get to the next stage in order to drive how much investment is required.
Yeah, and like if too little, then I mean if it's like, yeah, okay, 2%, 3%, it's really not worth their time, because after subsequent rounds, like then it's going to just be 0.3, 0.7%, and it's not worth their time, because angel investors again are quite proactive, and they want to obviously have some ownership, but giving up too much, then you lose control, and you also lose your ability to control the conversation or the negotiations. It really depends on like where you are as a business, but it can range. Like 5% is quite low. Like I've seen a deal where it's like, oh, $10 million valuation, but doing 5%. It's like, well, then what's the point? Like, why not just go get a loan and do it yourself? Like, why wasting the time? So they certainly want to have a higher percentage, but it can range from like 10 to 20% as a whole group, not just as an individual, right? So there could be 5 investors that are putting in for 10 or 15%.
Okay, and then tied into that, what terms does the average angel investor request? So for example, board seat, safe agreement terms, etc.
Yeah, so not so much a board seat. That usually happens in venture capital, because I mean the angel isn't there to steer the ship. It's just more like, okay, here's the money, and I'll advise you. It's still early days for the structuring of the board in that way. And then I mean, if you do that, then you could potentially lose control earlier in the game. So typically, when board seats come into the conversation, is around the venture capital, especially private equity stages, so late mature stages. Terms, oh gosh, I mean, they can change. I mean, because a convertible note debenture is, I mean, there's maturity, there's interest, there's a payback period if it's, if milestones aren't achieved at a certain time period. Simple agreement for future equity. It could just be like a 15% discount at a $5 million valuation. And so, once the future equity takes place, then, they get a 15% discount on the money that they had put in the seed stage. So really it can fluctuate. But for the most part, I mean, angels, like if you sense any predatory actions, just walk away. Like, it's not worth your time, because it's your business. It's in many ways like your child. Like, you do not want to lose control of it. And if you sense any predatory, or if you have any concerns of it, then reach out to your business advisor, mentor, reach out to people on LinkedIn that are investors, be like, hey, like, what do you think? Feedback, just try to get some sense of it. Don't give everything up, right out of the gate. So terms and conditions can really, really fluctuate, but for the most part, 15, 20% discount on a X valuation.
Okay. And the next question is, are all angel investors accredited investors?
It's changing, because now there's private equity crowdfunding. So non-accredited investors can go on a on a crowdfunding, platform, not like Indigo or other like crowdfunding. It's like private equity crowdfunding. So anyone with like $1,000, to their name can go on and invest monies through those PE type platforms. But for the angel networks, yes. And accredited investors usually just means that they understand the risk of investing, and it's your money. And if you lose it, like, too bad, unless if you do see something. And yeah, in the terms and conditions, it's always good to have legal perspective. If they provide you with terms and conditions, definitely get legal perspective. Because you don't want to have anything predatory, that's in there that could creep up on you.
Okay. And do angel investors look favorably on social enterprises, or is that a different animal to them?
I wouldn't say a different animal. It really just depends, on the individual. We have, in this region, there's different classes of investors, that we've kind of identified. And, there's one category, we call them city builders, right? So very high net worth individuals in, say, Belleville, Brockville, Kingston, Cornwall, Smiths Falls, that, they have their, they do 5 or 10 business, deals like a year. And then there's the philanthropic side of things as well, that they want to put their money into it. So it really depends on the individual. And more often than not, I would say a majority no, because as angel investors, by definition, they're there to see a return on their money. So it would be going through it. It'd be going through, and some angel networks, if you reach out as a social enterprise, then they're just like, no, sorry, we can't help you. Others, they might. But as a social enterprise, there's, the national, help me with this one, National Social Value Fund, I believe. So there's one, thank you. So that's a new fund that started, I think, slightly before COVID. So they help with social enterprises, which I think is a great cause. So have a look at them. There's the Kingston Social Venture Fund. But there are options out there.
So the next question, I think, kind of ties into some of the previous questions. So how much is a standard remuneration for board members? Is it typically monetary, or does it include stocks or options as well?
It depends. It really depends on the remuneration. It could be, I wouldn't pay. It might be, there are, I'm trying to think. I literally just did this a couple of weeks ago with a company that I'm advising. Like, I'm just, getting like, a very small percentage, like 0.8% to advise the board. Right. And just, give them direction and perspective on the marketing side. So help with the marketing and communications. It really depends, but early stage, if you're looking, I wouldn't give up your board right away. As an advisor, invested, like, it'd be vested over a period of time. So if they leave after 3 months, they're not going to keep that 0.5 or 1%. It would have to be over a period of time. Have that type of language in there, which helps, even with your employees too, right? It's like, here's 10%, but if they leave after 3 months and they keep the 10%, well, that doesn't do you any good. So having language in there that says, well, you need to be with the company for a minimum of 12 months. There's a vested period. So maybe after the first 12 months, you get 0.3%, 0.4%. But you stay for 12, 18, 24 months, then you get the full percentage that was initially discussed. So especially early stage, paying for a board member, I'd rather use that money to fund growth and fuel growth, rather than just like, I got to pay this person, I got to pay that person. At the end of the day, it's just all about customer acquisition and building your business.
So the next question is, if someone wants to present their case, who should they present it to?
So case, I'm guessing, would be the business. Who should they present it to? Everybody. Yeah, everybody. Best word of advice that I've been given, that I would encourage everybody, is, instead of pitching right? So you reach out on LinkedIn, it's like, hey, I got this idea for investment. More often than not, they're just going to turn you down. But if you ask for feedback, now there's the icebreaker. It's like, hey, I see that you're in this healthcare innovation space. You've done very, very well. Love your article on LinkedIn, last week, and I'd love to get your feedback on something. Because then, rather than it's a different perspective, and it's just psychologically unlocks or breaks down those barriers. So ask for feedback, not for money.
Thank you. So the next question is, to target the right audience for investors, let's say alternative energy medicine, holistic health, is there a place one can go to access contacts? I am thinking of the high-tech startups. They have a wealth of opportunities to contact investors. For the health environment, any guidance would be appreciated.
Sorry, could you repeat that? The first?
Yeah, so they're looking for a place someone can go to access contacts,
right,
specifically for like the health environment.
Yeah, accessing contacts. Just start door knocking, building relationships. People keep their Rolodex, quite close until you start to build a rapport and they know who you are. In regards to contacts, pre-COVID for me, I'd go to every conference that I could. I'm an extrovert, and I have the ability just to go and talk to every single booth and talk until my face goes blue. But actively listening, always actively listen. Yeah, resource. There's super clusters. There's innovation centers like Launch Lab or Invest Ottawa out of Ottawa, Communitech out of Kitchener-Waterloo, Mars in Toronto, which is essentially like the hub of the innovation centers across Ontario. They typically have resources as well, but just start by asking for help, right? Asking for feedback and building rapport. It is a long game. It really, really is. But it's important to build those relationships because they might not invest today, but when you go out for a Series A, that they might consider going in on the round.
Okay. Going back to crowdfunding, is having too many people in the cap table could it cause issues down the line?
Absolutely. Yeah, absolutely. Because then it can just get really messy. I think 30 would be the most, and then anything more than that, it's just like, okay, well, then it can take a long time understanding. It's like, okay, what's this person doing? Who's this person? What are they doing? Like, what value what's this? Yeah. So it can, and what stake is a common preferred stock? Like, where are they at? And it can get confusing, and it can really bog down the time of. So the other important thing actually that I need to add to this deck is, it can take many months to get capital. So understand that, especially in Canada. Unfortunately, in Canada, raising capital can take 3, 5, 6, 7 months, to do it. Whereas in the US can sometimes take, like a month or 2 months. Like a company I'm advising just couldn't raise money fast enough here. So went down in the US and, was able to, to raise money exceptionally fast, down there. So understanding the landscape and your positioning. So simplifying your cap table, having your due diligence package. So, not a detailed business plan. Nobody's going to read that. They just want to see your deck, your projections. Like, do you have some IP? What are your customers or LOIs? What does your cap table look like? Sometimes it will happen during late stage fundraising, Series A, Series B, is that they'll just, go and buy up 10 or 20 of those small, like 0.5, 1%, and just try to, that way they can also have more control over the business, but try to simplify it as much as possible, really.
Great. Okay, so that, I believe, brings us to the end of the chat questions. Let me just see here. If anybody else has any other questions, feel free to pop it in the chat, or you can unmute yourself and ask the question.
Hey, man, I'll go quickly.
Sure.
I've been reading this Guide to Entrepreneur to Startups by Steve Blank, and he says that a a startup is a company in search of a business model, and that you're like in those early stages, even at pre-seed, you're actively trying to discover what it is. So is it okay to maybe bring that frankness into the slide in the pitch deck about the business model and identify what you suspect might be the things you're testing for, or rather than proclaim one to be the known thing?
Yeah, and I mean that's a tricky one. I think having your said business model, your roadmap, like where you are, talking about it, but then having it's like, okay, well, with your money we can test. So there's option 1, option 2, option 3, and your money will be able to kind of test some of these hypotheses, right? And I think being frank is also helps, because it just shows that you have the acumen, rather than, I mean, when I did my first funding in his early 20s, I'm completely aloof to 90% of what this deck, what this presentation I just walked you through. So but not knowing the direction of your business model also does potentially put you into into a hole a little bit too, because it's like, okay, well, if you don't understand, then go back, figure it out, and then come raise money, rather than I give you $300,000 and you're looking to kind of further test it. It's like, well, that could be a waste of money then, and if you don't know. So there's the kind of two sides of the coin, and I'm more so on the latter, where like if you don't know, then you're just you're just throwing my money, the investor's money, against the wall and seeing what sticks. So go back, battle test it, further develop it a little bit more. Maybe it's just a small little bridge. Maybe you just need 50,000 to further test it, right? Or validate some assumptions that you might have.
Okay, there's another question in the chat. Who has SOAN invested in the last year, and any female founders?
Yes, female founder, Karen Bernay out of Cornwall area, Active Care, and it is a IP play for female incontinence product, and very, very successful individual. Was very successful at raising money. That was in the last year. Another company that we filled the rest of the round, so they're looking to raise $2 million, and then a couple of our members put in $60,000, which was Marrow Technologies, which is an Internet of Thing type cleaning supply, for industrial facilities. In the last year, there's a couple others. I'm not sure if I could throw in the public domain, but one that was the first investment of SOAN was Mosaic Manufacturing, which does multicolor 3D printing, and they just released a very significant product that can 3D print hundreds of products simultaneously. So they have rapid growth. They have dozens and dozens of employees, and have been very, very successful. Some other investors have done invested in quite a few. I think we've invested in 25 companies and seen hundreds of pitches.
Great, thank you. So looks like my chat is frozen. I don't know if there was another question following Barbara's. I don't know if you can see it in there.
Let's see here. Who was on any females? Yeah, maybe. Okay. 25 in the last year? No, since 2014. And some businesses too that might not. I mean, for SOAN, we're pretty agnostic. Like, we don't have an investment thesis where it's like just healthcare innovation or ag tech or advanced manufacturing. We're very, very agnostic. And if something is passed by, but selection committee considers it like a really good opportunity, we're really just the matchmakers. Like, we don't provide the terms. It's really just between the founder and the investor. But we typically socialize opportunities across the other networks within the network as well. So there's been a number of deals outside that we've socialized to help because other, especially like in Toronto, there's, many more members, and in Ottawa. So, we do our part to cheerlead for businesses in this region. And as part of economic growth as well. And for SOAN in particular, a majority of our investors are very interested in local economic, growth, right? So, in setting operations in Cornwall, or setting up an operation in Kingston, Belleville, Brockville, Picton, Quinte West area, very, very interested. So if there's a company, anything else?
Doesn't look like there's any other questions. Feel free to unmute yourself if you do have further questions.
Yeah. So,
okay.
I mean, at the end of the day, it's, work your pitch. Early stage founders, I mean, don't worry about making it perfect. Just get it out there. I've worked with a number of founders that kind of had that innovators, dilemma, where they're just so focused and concentrated on their product based on their vision, and not actively listening to, to their customers, whether it's through Net Promoter Score, NPS, whether it is just basic email surveys, whichever it is. At the end of the day, you're trying to provide value to your customers, and if you can speak to that point, investors will appreciate that. Understanding your unit of economics. If you don't know what they are because you're pre-revenue, and typically for projections, you need to have historical data to know where you're gonna, where you can kind of go and map it out. Make some assumptions. Just do some quick Google searches and be like, hey, like source 1, source 2, source 3 says, typical customer acquisition cost is $50 and lifetime value is $500, and month over month growth is expected to be 25, 30%, whichever it is. Make some assumptions, and know that someone may not be an investor today, right? They could be an investor tomorrow. So keep them in the loop with your regular, with your like investor newsletter updates. So every quarter, right? Every 3 months, send out a newsletter like, hey, Michael Coates here from Acme Incorporated, and it's great. We've raised $200,000. We've hired 5 people. We've gotten 100 customers. Just keep them in the loop. And LinkedIn has become a very powerful engine. So just don't cold outreach. It's part of prospecting. Hit follow, view their profile. They can see that, and engage and comment with their channels. And it's a lot of it is just building relationships. Any other questions? Okay, so maybe we'll leave it at that. And then, as I mentioned in the chat a few times there, this session is being recorded, so we will be sending out a link for it. It will also be uploaded to our YouTube channel. I'll include this in an email following this session. It'll probably be a little bit later this week. If you have any other questions, feel free to email myself or Michael or Carrie from the WeCan program, and we're happy to help you out. Thanks very much for coming.